I'm Steve Forbes, and you're watching Traders Nation.
You are watching Traders Nation. My pleasure to have back with us David Scranton, once again, CEO and founder of Sound Income Strategies. David, welcome back to Traders Nation. How are you today?
I'm doing great. How are you?
Oh, fantastic. Thanks. All right, so inflation numbers, that's the trick of the game here. They're currently at the highest level since headline rate of 2012, David, and the highest core rate since January of 2017. What helped bring this on?
Well, it's interesting because inflation numbers are looking good, which the Fed is looking at, which they want to look at.
Sure.
And, of course, that signals demand for goods and services. And the Trump administration, of course, wants to lean on the fact that this is going to get them closer to this 4% GDP growth rate.
Right.
And that's good. But the question is it really something that we need to be concerned about? Mm-hmm. Is it something that the Federal Reserve should act on? Should they expedite raising interest rates, or shouldn't they?
Right.
And I think they shouldn't.
Yeah.
First of all, history is filled with examples of the Federal Reserve overreacting to perceived inflation, increasing rates too much, and actually creating a recession.
Right.
And this time, I think it's particularly true, and here's why. Inflation is really much of it's based upon the change in demand for goods and services from one year to the next. Mm-hmm. And we have an increase in demand right now, and a lot of that has to do with the new tax law. Finally, people are starting to see more take-home pay in their paychecks because their withholding taxes went down, and that allows them to spend more on goods and services.
Sure.
Corporations got a windfall this year in profits because they had to pay less to the government. So now their profits are going to be up.
Yeah.
And as a result, they feel like, okay, maybe I can make more infrastructure investments, which means that now, it theoretically creates more jobs for people in other places and so on and so forth. But that's a one-time event. That's a one-time kicker. And so this year, you've seen that increase in demand because of that, and then it moves the baseline, but then we go back to the same old ho-hum annual increase of demand from one year to the next.
Right.
And nothing changes.
Yeah. So the Feds, they should have an idea about what we just discussed, what you just said. It's a one-off. It really is. But they're just, it almost seems like they're anxious to raise those rates, and certainly the federal government, this administration, is against that because we want to get better GDP numbers, we want to get better jobs, we want expansion, we want more of everything, don't we? So it's almost like there's a little dance going on, isn't there?
There is, and of course, the Trump administration takes pride in what's happened with the stock market since Election Day. So they're saying, slow down, slow down. The last thing they want in 2 years is to have a recession. That's going to cause, a Democrat to get pushed back into the office. So they're trying to be careful there. The Federal Reserve, you can't blame them. They're anxious to raise rates because they need to have more ammunition for the next recession. And when somebody is anxious to do something, sometimes it's easier to look at the positive signs and subconsciously overlook the negative, such as the one we're talking about, right? Everyone does this. I mean, most stockbrokers are ethical. They tell people, look, you can make 100% gain on this or you can lose all your money.
Right.
But what people hear is the 100% gain because that's what they want to hear. And they kind of downplay mentally the part about losing all their money.
Right.
And smart people are susceptible to this too because the human mind works that way, right? We make decisions emotionally. We try to find evidence to justify what we want to do. So if the Federal Reserve wants to raise interest rates so they have ammunition for the future, now they're, in essence, data mining. They're looking for data that supports that. But it doesn't make it any less dangerous in terms of the probability of creating the next recession.
Sure. Now, the Feds, as we all know, and certainly have lowered rates down to, zero, and an unprecedented level for a long time. And like you said, the key word here is having that tool back in their belt in order to pull it out again in the future if they need to. So that they have this interest, don't they, of raising those rates minutely at a time throughout now into the coming years, don't they?
Yeah, they do. They have to. They have to do something.
Yeah.
Or what happens in the next recession? We go to negative interest rates.
Yeah.
And, that happened in lots of countries. We haven't done it yet, but we're still susceptible to it. It very well could happen. We're not immune to it.
Right.
And they're trying not to get in that situation where it's overstimulating even more so than we already overstimulated it post the last financial crisis.
Right. All right, so the Federal Reserve Bank is maintaining this hawkish tone. We're talking about that here right now. But many central banks in other parts of the world maintain a more dovish tone, wouldn't you say? And so what can we expect out of the Fed's end? Certainly it adds to this conversation. It may raise those rates a little bit more at a time, but what can we expect out of the Feds over a period?
Well, you see, and that to me is the biggest risk right there. And, people try to downplay it. I've had economists, even on my own television show, try to downplay that. But the reality of it is, we are in danger of creating a flat yield curve right now because of what's going on all over Europe and other countries. All that dovishness, which is what we call it in our industry, right?
Yeah.
It's keeping long-term interest rates down because when you have countries like Spain and Italy who arguably are in worse financial shape than us, and their interest rates on their long-term bonds are less than ours, it doesn't make sense. It creates a demand for our bonds relative to theirs, which keeps long-term rates down. So if the Fed keeps raising short-term rates and long-term rates stay low, then forget it. At that point, you're going to flatten out the yield curve, which will cause a recession. There was one point, I want to say the week before last, where literally the difference between the interest rate on a 2-year government bond and a 30-year government bond was 1/3 of 1%. In other words, to tie your money up for 28 more years, you're only getting 1/3 of a percent more. That's so ridiculous, isn't it?
Yeah, it's a sliver. It really is a sliver. Interesting. So